Good morning. Welcome to the BYU Real Estate Webinar Series. My name is Barrett, Slade, Professor of Finance and the host of today's webinar. We hope that you've had a wonderful and safe, enjoyable holiday break and Christmas this year. We're excited for the new semester and the webinar series that we have planned. And so we hope that you'll join us throughout this semester. Before I introduce our speaker, I'd like to announce that on February 10th, Danny Wall from the University of Utah will be joining me to host a panel where we'll be talking and learning about some of the nuances of the Utah housing market. We'll be sending out an invitation to that webinar in the coming days. Please note that after our guest speaker concludes at 11:35 a.m., we'll have about 10 minutes for Q&A, and then we'll conclude at 11:45 a.m. So if you have questions for the speaker, please click on the Q&A button at the bottom of your screen and type those in, and then we'll get to those as time permits. So today we have with us Mr. Ashley Powell, who is the president and CEO of Property Reserve, Inc. Ashley has over 37 years of commercial real estate industry experience and leads a team of about 200 professionals overseeing a global portfolio of office, industrial, apartment, hotel, and land properties. Ashley, it's so good for you to be with us today. Thank you for taking time out of your schedule to teach us a little bit about Property Reserve and some of the opportunities that you see in the marketplace. So take it away. Thank you for being with us.
Oh, Barrett, it's so great to be with you. Thank you very much for this opportunity. I owe so much to BYU. I don't know if you realize, but I went to BYU, transferred from another school, left pre-med, and joined a very good friend as a non-member of the church. And over a period of years, got baptized, went on a mission. And it really was a transformative time in my life, to which I owe a great deal. And the fact that I'm at Property Reserve is part of that foundation that came out of BYU. So thank you.
Super. Thank you.
I would love to share some slides, and we'll go through. I'll try to leave more than ample time for question and answer as well, Barrett. Let me, okay, share screen here.
There you go. Looks great.
Fantastic. Let me see if we can advance this now. Property Reserve, Inc., just by way of introduction, is a real estate investment arm for the reserve funds of the Church of Jesus Christ of Latter-day Saints. What I thought might be helpful, we were founded in 1960. I'm going to just tell you what we've done in the last couple of years. We've put a significant effort into increasing the fund investments with the specific purpose that allows us to pivot faster into new opportunities, go into locales that we haven't been in, and most importantly, learn from some of the best professionals in the world. We've put a lot of focus into risk assessment and specifically benchmarking ourselves against those best players in the world. And happy to say that we've been able to beat those industry indexes and trailing 10, 7, 5, 3, and 1 year measurements. We've also tried to be better at our decision-making by making sure it's a more collaborative process. We've put time and effort into becoming a strong direct investor versus being a separate account investor. The reason is so that we build in-house market and product expertise. We want our people to know, we want to limit ourselves the number of markets that we go after, but we want our people to be the very best in those markets. We have a unique attribute in that we are a direct developer. Unlike a lot of capital allocators who do development through third parties, we actually have a very talented team that has a number of development projects going on. Those run the gamut of industrial, multifamily, single family for rent, office buildings, etc. What we're really trying to do is build people more than build buildings, because as we launch into joint ventures at some point, we want our people to have had a lot of experience in developing, so entitling, designing, building things, and that will make them very good overseers or managers of other joint venture partners. We're blessed to have a wonderful land development team that we're reconfiguring at the moment, so they're out in front of the vertical development pipeline. And ultimately, the focus is on people. One company, one mission, with very clear career progression paths. All presentations today tend to start with this great disruptor of COVID-19. This is an interesting set of data points because it's measured off of the viral content of wastewater, and therefore is more forward-looking than a lot of data that you see through CDC and others, because those require somebody to have symptoms, get a test, get the results back in the test, and then report. What this shows is we're not in a great place. Admittedly, we're several X the worst time in prior history over the last 2 years, but there's been a turning of the corner, and things were a little worse in the Northeast. The red line is the West. You can see that initial bump up in early 2020. Actually, the West did pretty well. We hit a bump in the road around November of 2020 through first quarter 2021, again in kind of summertime, but we've done generally better than other parts of the country. And in this particular Omicron situation, we're really doing quite a bit better. Again, we're optimistic, but at the same time, people need to be careful because the viral count is still many X what it has been previously. The next part I want to go through are macro trends. Macro trends endure. They have only been accelerated by COVID-19, and therefore they're what we base a lot of our investment thought process around. E-commerce penetration started a long time ago, but it certainly got accelerated by about 5 years thanks to the pandemic. The migration to the suburbs that everybody reads a lot about, we'll show you stats today that actually started some time ago. It's only continued and been amplified because of the pandemic. Workforce mobility and flexibility became a reality. I'm really happy to say that pre-pandemic, one of our fantastic asset manager portfolio managers was able to have the flexibility to be a fantastic mom and a fantastic portfolio manager and be able to fit all of that in together. And we were so glad to be able to provide that flexibility. Now, obviously, there's far more flexibility and far more examples of that going forward. The migration to the Sun Belt has intensified, but that's been going on for decades. Retail store closings were going on before the pandemic. They've been amplified. Life science has now become mainstream. And Barrett, I think one of the funny things to me is that every kind of Class B office building all of a sudden is now rebranded as a life science building. And people think that's the great way to get out of a trap that they may be in right now. There's too much capital for only 4 sectors. Real estate has historically been categorized as office, industrial, retail, and multifamily. There's so much capital. We'll talk a bit about different alternatives today to be able to accommodate that amount of capital, especially since 2 of the 4 primary ones have kind of been taken off the table. Retail and office investment has slowed down significantly. And many people are looking at expansion into non-gateway markets. This is intended to give a comparison between Europe and the United States. I think we can look to Europe as to where future path for us could go. I say that because we have lower interest rates and returns, similar to what Europe has had for many years. We're tending towards a more lifestyle, more experiential method of living versus acquiring of goods. the live-work balance has become much more of a topic of discussion, as it has been in Europe for years. Our birth rates are now lower, and there's more social focus, or ESG, than what there has been in the past, and Europe has led the way. The migration that we talked about, when I say it happened prior to, this measures from 2008 to 2018, domestic migration between the in or out of states. Everything in the orange is a Sunbelt state, green a non-Sunbelt state. You can see Texas was gaining people, and Florida was as well, for the 10 years prior to the pandemic. And places like California, even though it's a Sunbelt state, lost, and New York especially lost. During the pandemic, it only accelerated. California's out-migration of 429,000 is almost matched by Texas's in-migration of domestic participants. Same thing, New York to Florida. The long-term trend in U.S. Treasury rates has been something that's been very surprising throughout almost my entire career. I started in the early 1980s, so interest rates were much higher. Over 30 years, the average of the 10-year U.S. Treasury rate has dropped almost 0.25% per year, pretty consistently over that 30-year period. What that has caused is that the cash yields have had a very similar drop. So real estate return very much tied to debt, cost of capital, a drop in U.S. Treasuries, very much mirrored in dropping returns in real estate. As we talk to our counterparts that help run the investment reserves of the church, one of the big themes is, and it's true for all capital allocators, that the fixed income right now is giving people a negative real yield, meaning that the amount that you would earn on a bond is less than the rate of inflation. Now, that's certainly true in 2021, where the headline inflation was 7.1%. But even as it tapers down, as this chart shows, I think everybody says 7.1, 2021, going to into the 3 range by the end of 2022, and then tapering down into kind of 2 to 1/4, 2.5 range. And that has been that says that we are in a pretty good place, and we don't have to worry as much about kind of 1980s inflation that you saw in the earlier slide. What that means is that you should be able to project forward as to what types of asset types you want to be in. You should have some certainty and some conviction about your strategy if you think that you're not going to get blindsided by runaway inflation. At the same time, we do protect ourselves against it in how long our leases are, our product types, and we'll go into how that informs our thought process in alternatives. But bottom line, a lot of capital coming into real estate because fixed income has a negative real yield at the moment. This shows by decade. So the first bar, the decade ending in the year 2000, the decade between 2000 and 2010, and then up to 2020, and then the slight difference over just the last short period because of the pandemic. If you look at 2020 decade, really the decade of the 90s, you had 41% was allocated towards office. Now that's changed a little bit each decade, but it's really changing now where you see 27%. Apartments, a bit of a shift, 17%, not as much of an institutional asset class a number of years ago, very much an accepted institutional asset class today. Industrial, I think most people today would like to have a lot more than is shown on this chart. You can see it was 24, it kind of fell out of favor down to 17, and then it's gone up to 28%. There are other changes though happening with investors. As you look forward, PREA, the Association of All Pension Real Estate Advisors, is slightly more in favor of residential, multifamily specifically, and industrial is very close to that. A little lower, office, then a whole cadre in blue of alternatives. And then out of favor, retail. But probably most startling is the shift in style. Most investors going back a while ago would have said we're primarily a core investor. But as they've chased yield, because again, interest rates coming down, yields coming down, they've pivoted to more value add and opportunistic. Value add being you buy a building, you lease it up, you reposition a building, you do some sort of renovation. Opportunistic largely being development. How did we do in 2021? The numbers aren't entirely in. This is based upon the best knowledge we have. Industrial screened in 2021, over 30% returns. There are some advisors who think their portfolios went up 40%. Apartments also did extremely well. Office, retail, naturally were laggards. The return outlook favors industrial still going forward, and we'll talk about why, apartments, and other alternatives. So where is our current investment focus? First, to selectively expand into target markets. Two, to develop things. There's a broader gap between the return on cost and the cap rate than typical, and you're paid well to be able to develop today. Industrial, it's good to build versus buy at a core basis, and we'll show you examples of that. Residential, same idea. And alternatives, there are a number of things that we are looking at today, and we suggest that people will look at. Hospitality, senior housing, self-storage are just some of the examples. Data centers, et cetera, also fall in this category. Talking about markets, the yellow line on the left are gateway markets, the red non-gateway. You can see in the GFC, gateway markets performed longer and went into that recession later than non-gateway markets that hit a lower bottom, but they rebounded faster. As you look into 2021, however, you see the non-gateway market return, that red line is higher than what the yellow line is. Same idea on the right, the spread of overperformance of gateway versus non-gateway. You can see non-gateway doing better than gateway, gateway underperforming in the blue. But also note that from about 2013, 2014, gateway markets were kind of breaking even and started to underperform very, very slightly. Again, a lot of these trends have been going on for a while. By asset class, the income yields are different than what the projected overall returns are. You'd note on the far right side, lowest income returns, residential and logistics, but you just saw a slide that said overall returns are expected to be among the highest. The reason being that investors demand a higher certainty, a higher income profile if they're going to go towards the left side because they may not get as much appreciation. So retail, as an example, somebody would expect a pretty high cap rate and a pretty high cash flow because they're probably not going to get as much appreciation out of that. Industrial has been a phenomenal story and will continue to be for some time. The United States is about the middle of the pack of developed countries as far as e-commerce penetration. We're at about 13%. You can see the high of South Korea, 38%, is very significant multitudes compared to us. The UK is a good example of where we could go. There are 30% penetration. At the same time, parts of Southern Europe are lagging a bit behind, but we're solidly in the middle of this pack in with Germany, Australia, and Japan. U.S. industrial demand has been significant in 2021, but a cautionary note is where that demand comes from. As e-commerce sales have grown, it demanded 17 million square feet, say, of new industrial buildings. But a much bigger part of that demand came from switching from just-in-time delivery to just-in-case. People were concerned because of supply chain problems that they wouldn't have enough inventory on the shelves. Therefore, inventories have built up by 8.7% in the last year. That caused 496 million square feet of net absorption that was needed. The industrial rent growth has been just nothing short of phenomenal for a number of markets. Inland Empire, you'll hear over and over, 67% rent growth year over year. Salt Lake City in the top 20 with a 10% rent growth, very strong. Other markets near us, like Phoenix, 16.6. So across the board, unbelievable rent growth. Our vacancy is very good. 1.9% is incredibly low. Now, Inland Empire, LA, Orange County, you can think of as one market essentially, which really puts us in the top 5 as far as in lowest industrial vacancies in the country. The 5-year average or the 5-year forecasted rent growth is quite high for Salt Lake City at almost 25%. Again, Inland Empire is the top at 37%, but this puts it among the best markets in the United States. This is some very up-to-date information over the next few slides. Comes out of Inland Empire. Let me bring it up because it can be a canary in the coal mine and an indicator of tightening across major markets. It does extremely well because it's tied to the ports of LA and Long Beach. But if you look across cap rates in blue, year one cap rate across 5 deals, 3%, 306, 3.25, 284, to low 2s on actually an older building built in 1991, so it would have had lower rents. You look at the price per square foot, 300, 383, 270, 250, 240, extraordinary prices. You used to be able to buy an office building for that kind of price per square foot. Sale comps on land. As a result of this increase in rents, the increase in investor demand, land has shot through the roof. These prices, the third line down, 106, 107, 96, you know, call it roughly a little over $100 a foot, is per land square foot, not per building square foot. So if you got 40% coverage on a building, you're in the mid 200s on your building costs just for the land before you start constructing anything. A lot of data on this. It shows the increase in rents in Inland Empire West just a few years ago in the lower 50s, triple net per month, now rising to well north of $1 a square foot. Residential's had a not quite as dramatic, but a very strong story. Wage growth is strong, but it will not keep up with rents and home prices. The graph on the right shows that over 2020 to 2025, wages will grow at an annual pace of 4.5%, and apartment rents will rise just slightly faster than that, which is very strong at north of 5%, but both of those will lag behind home prices. There's a lot of talk about, as we pointed out, movement from primary coastal cities to other high quality of life cities. This is intended to point out that it wouldn't probably cross those gateway cities off the list entirely. If you look at San Francisco apartments over the trailing 2 years, rents dropped 3%. What that doesn't say is they dropped much more dramatically in the first 6-12 months of the pandemic and then came back. But over the next 2 years, they're expected to go up 11.6%. Phoenix is kind of the opposite, right? Over the trailing 2 years, a whole lot of in-migration, very strong rents. And over the coming 2 years, that rent forecast is a bit more tepid. Salt Lake City, better story than Phoenix. The 2.6% forecast over the next couple of years, and not quite as dramatic on the uptake over the last 2 years. And Wasatch Front, I believe, is undersupplied in apartments compared to similar cities. If you use a ratio of how many, what the population is per unit, then we have more bodies per available apartment unit in Salt Lake City than, say, a Phoenix or a Denver or the US overall. In theory, we could be undersupplied along the Wasatch Front in the number of apartment buildings by a significant number, up to 52,000 units. A number of people are looking at alternatives. The reason, again, this wall of capital, the shrinking of the definition of core in the sense that office and retail a bit out of favor, so you only have two product types left. So let's talk about three different areas of alternatives. Hospitality. This is the thesis behind hospitality. Hotel occupancies plummeted due to pandemic travel restrictions. The sector was sound prior to the pandemic and is expected to recover. The reason for that, by the way, is that baby boomers are retiring younger and healthier and with more money than prior generations, and the millennial generation has a strong propensity to travel. Purchase prices were discounted, I'd say 15% range from 2019 values. Debt solutions evaporated for a period of time, which compounded the distress. Most importantly, hospitality is an unbelievably strong inflation hedge because rents reset daily. The income returns are stronger and should be stronger than apartments and industrial because there's more volatility in lodging cash flows. But there's deferred capital obligations and capitalization that could provide ongoing opportunity. Hotel brands require hotel owners to put a certain amount aside to do capital renovations on a regular basis. They kind of put that aside through the pandemic because of the distress. Lenders also kind of did the same thing. Some of that will come to roost in the next year or two. Revenge travel will continue in 2022. You've read about it, you've heard about it. A lot of them went to places like Florida, Hawaii. Global flights dropped by 64% dramatically in April of 2020, but importantly, they're still down 20% as of December 2021. Hotel recovery is not expected to happen till 2023. You can see that a lot of that recovery has already happened by the end of 2021. Still a little bit more to happen in 2022, 2023, the yellow line being occupancy. Another good alternative for people to look at is senior housing. We're not in it. I would just tell you we're looking at it. The reason is the demographic trends. And we think it's still a little bit early. If you look at the middle of the silent generation in red, today's 85-year-old resident was born in 1937. When somebody hits their 80s, there's a much higher chance that it is a needs-based decision versus a choice. The big bulge of the boomers are turning 60. So that is not an age at which they need to go into senior housing. In fact, by 70, often they are not. But you can see that the active lifestyle apartment, so kind of very light on the acuity portion of it, is actually coming. It has a pretty strong demographic wave that's coming. But that's probably, we're not for till the end of this decade before assisted living, other things really start to hit the sweet spot, but it is coming. One of the key parts is that why I think it'll be a good sector is that the shrinking caregiver ratio will demand more senior housing. Why? Because lower birth rates, higher divorce rates, is meaning that the ratio of adult children who can take care of older adults is dropping from 7.1 in 2015 to half of that in 2036. Returns are also higher significantly for senior housing or for multi-family housing. The reason being it's an operating business, more risk, et cetera. So that is natural. But as a comparative between the green and the purple line, you can see that that spread has increased a bit. And the total returns versus multifamily and all properties in the NPI or core funds, you can see that the spread is widening. Another alternative interest is self-storage. Self-storage is a resilient sector. The demand's driven by life-changing events. It's utilized, interestingly, by 10% of all households. It's a highly fragmented ownership, which is one of the things that's also true about hospitality and senior housing. 70% of self-storage owned by mom and pop organizations. It's driven and does best where there's high density and low income drive for rent growth, but most importantly, just high density. Intense capital demand doubled prices in the last 5 years. Construction costs went up, land costs went up, labor went up. The prime assets are trading at an unbelievably low rate now, mid-3 cap rate range. Again, a lot of capital's already been attracted to this sector. And the key risks include new competitors and rising construction costs. This measures starting from a base in the fourth quarter of 2003, how much NOI or income has grown. And you can see the dramatic increase between 2020 and 2021. Why? Because people needed to get goods out of their apartment, out of their house to create room, either for living or most often for remote working. And as a result, self-storage took an enormous jump up. One of the things we're looking at is that, we would not expect 28% to continue, but does that plateau? Does that come back down a little bit? So let me just conclude with a few thoughts. One is a number of investors are challenging what the definition is of core real estate. For instance, if there's a development of industrial buildings, a build-to-suit for Amazon, you already have a signed lease, you have a GMAX contract signed with your contractor, you have full entitlements. Is it at that point more core than it is opportunistic? 2, analyze constantly what differentiates you and provides you with a sustainable and ongoing competitive advantage. And as a spoiler alert, there are very few things that truly differentiate us from our competitors, but it may only take one strong, durable differentiator to make all the success in the world. Assume that everyone else is having the same thoughts. A lot of bright people, a lot of capital in the world. So you have to analyze thoroughly and then move quickly and with conviction. And finally, recommend that we prioritize people and principles above everything else. Our business would not work without the 200 dedicated people that are part of it. I'm grateful for the opportunity to serve with them. I'm grateful for the mission that we share in common. And for those that are at BYU and launching on the journey, it is a wonderful career. I've enjoyed almost every day of it. It is exciting, it's different, it's challenging, and the challenges are intellectually stimulating, and most importantly, it's filled with just great people. So I share that with you, and thank you. And Barrett, open it up to questions.
Okay, thank you. That was very good. Ashley, we've got one question here. E-commerce sales in third quarter of 21 were down 13% of retail sales from a previous peak of 20%. do you think the e-commerce trend is softening?
Barrett, I look at where other countries, I always try to look at something else that kind of paves the way as to where it could go. And I look at where the UK has gone, I would say no. I think there are momentary blips in the road. I think there's still a long path ahead.
Great. Okay. Thank you. What about, tell us a little more about the mission and purpose of Property Reserve. Why do you exist?
Fantastic question. We exist as part of a three-legged stool to invest the reserves of the Church of Jesus Christ of Latter-day Saints. And I think throughout my career, Barrett, it's been wonderful to work on behalf of policemen, firemen, great, worthy groups of capital. But in this case, it is to make possible the building of the kingdom of the Lord Jesus Christ. And I don't think there could be a higher mission out there. I think in my mind, it allows the leadership of the church to be able to act on inspiration and make decisions without having to worry about how the resources that are behind it.
Great, thank you. Question pertaining to construction costs. You're signaling that you're taking more of a development position, and the construction costs have been absolutely crazy with labor and materials. What are you doing about that? How are you thinking through that?
It's a fantastic question and not entirely unavoidable. What we're trying to do is pre-order steel, make sure that we don't get caught in supply crunches. I remember in building 95 State, we had stone that was coming from China, and this is right at the beginning of the pandemic. We switched and we got stone from Italy because we just didn't want to get caught. We're looking at, in some places where we have enough buildings going up, putting in concrete batch plants bespoke to that area, pre-ordering steel, using the land we have. You're just getting creative across a whole bunch of different areas. And then I guess finally working with the very best contractors who have control of their subs, or great relationships with their subs, to make sure that, again, you don't get caught surprised.
Okay. We have a question that's asking about, can you share us one or two of your recent or short exciting development projects that you have in the works?
I think the two areas that I'm most excited about, single family for rent, we really stumbled across it because of land holdings in Phoenix, where that idea really took its original birth. And I love it because of the social component, in that you're providing, I think, greater housing affordability. That single family for rent product, our hope is it'll be able to rent for a premium called 10-15% above a standard stacked flat suburban apartment building, but give you, 4 walls and roof, a much better living experience, and be about a 20% gap to single family home ownership monthly costs. As homes are appreciating very rapidly, frankly, that 20% is probably widened.
Okay, thank you. I have a question. What is PRI doing in Asia?
We've pushed a bit into 2 different continents outside of the U.S. And we are, one, involved in funds there, and we'll continue that initiative. We have completed a development in Japan, which is multifamily and apartments, and we have other investments scattered around. I would say it's not a large footprint, but we do think that the APAC countries have a pretty good growth story. We think the U.S. is strongest. We think APAC has a very strong growth story as well.
Okay, thank you. Tertiary markets. We've seen, of course, a fair amount of migration, remote working, et cetera, has pushed the population and housing in some of the tertiary markets. What's your thoughts about that? Is this going to be a long-term trend, or what's your general thoughts about tertiary markets?
Well, I think when I first came, we had a large concentration in Salt Lake City, and I thought, it would be good to diversify and have a more holistic approach that took in, strong bias to coastal markets, et cetera. And at one point, Barrett, we looked at the amount of suburban apartment concentration that we had, and at the same time we were buying urban, dense environments, and thought for a moment, should we divest some of the suburban apartments? And the conclusion was no, and I'm sure grateful we didn't do that, because that has turned out quite well.
So overall, do you like the idea of some of these tertiary markets?
Absolutely. Yeah. I think that, places we're not in today that I think people are looking at, high education, Charlotte, Raleigh-Durham, et cetera. Those would be some examples. Obviously, the Austins of the world, Salt Lake, Denver, are high on everybody's list. The fact that Boise was one of the top performing markets over a number of years is something that is, I think, awakened every institutional investor.
Yes. Okay. Talk a little bit about office properties. They've, of course, used to be the darling of the core portfolio, and now they're not. Is there thoughts about doubling down, going back heavy into office with the thought that maybe the workforce will return, or are we into a hybrid forever? Are we remote? What are the conversations you're having about office?
Barrett, I wish I were smart enough to know that. That's the question everybody is asking. What I don't see is in New York, for instance, I don't see the asset pricing reflecting the amount of risk. A lot of uncertainty out there. I don't think anybody has the answer. Yes, there are tenants that people say are more tenants expanding than contracting, but at the same time, vacancy rates don't look like they're headed in the right direction. I'd say our own example in Salt Lake City and 95 State, we had very strong pre-leasing before about the same time we started construction, and pandemic hit. That pre-leasing evaporated overnight. Took months before anybody would answer the phone. That building's now sitting, if you included all signed leases plus the options that they have to take space, that's about half full at this point. I think develop brand new, state-of-the-art, well certified, ESG compliant, et cetera, buildings will do well. There will always be a flight to quality. I'd be a bit worried if I owned a lot of B quality office.
Okay, interesting. Talk a little bit about the land holdings in your portfolio and how that's quite unique generally, of having significant land holdings, and how that fits in with the mission and the perspective, your strategy, if you will.
Well, I think we're blessed by people much smarter and that came around decades ago that acquired land in the path of growth. A lot of it really came through farming and came through other avenues into the investment part of the church. But it has been, so how does it fit? It allows us to have access to land in a time when you saw from those industrial sides that land prices are escalating at an unbelievable rate. Two, it allows us to, because of holding it for so long, can allow us to be better stewards, more thoughtful, long-term owners, because you don't have to milk maybe every single nickel out of it. So I think that it gives us a better perspective as an investor over time. I agree with you, Barrett. It is a truly unique asset that we're have stewardship for.
Okay, thank you. Well, now let's just end with a little bit of a discussion on sustainability, ESG. I'm curious on what you're doing. A lot of private institutions are under a lot of pressure. And of course, we've seen Europe really embrace ESG, and it's coming our way faster and more intense. What's your thoughts as a private portfolio? Are you following suit? Are you measured about this? What are you thinking, and what are you doing in this regard?
I think, Barrett, one, we're not trying to check boxes. At one time, everybody said, yeah, I want to get to lead gold, lead platinum, whatever it is. That's been a moving target, and there have been other things that are probably more important or as important today, like a well certification. I think that it is inherent in our mandate, inherent in our DNA to be good stewards of the resources we've been given, whether that's a planet, that's a building, that's financial resources. It's what we have responsibility for. So I think you will see us as a broader organization continue further and further down this road. I think 95 states probably a pretty good example of the amount of care that we put into it. The good examples is, how do you clean air that goes throughout the building? Can you air purge every night, literally empty all the air out of the building, put it back in? How do you clean air that's in an elevator? What's, ionization that tracks particles and drops them all down to the floor? There's just so much technology out there. It's exciting and very much embraced by our organization.
Thank you. Well, Ashley, we're out of time, but I would like to we have students on the call today, and just one parting thought. If you were their age pursuing, getting ready to launch into a business career, do you have a nugget of wisdom that you'd like to share with our students as we end the webinar today?
Put people first. It's a people business. It's a relationship business in the end. And I don't think you'll ever be disappointed. Put people first.
Great. So, thank you. Well, thank you so much, Ashley, for joining us. It's been a wonderful time. For everyone that's on the call, we hope that you've enjoyed it as well. We look forward to seeing you on February 10th, where we'll talk about the Utah housing market. We hope that you all have a wonderful afternoon. And thanks again, Ashley.
Thank you so much, Barrett.